Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Wednesday, June 17th, 2020, and I am pre-recording this Trading Places Live for Thursday, June 18th. Futures are slightly higher for Thursday after a pretty weak afternoon. We saw the 10-year Treasury yield move lower in the last couple of hours, meaning that money was rotating into Treasuries, and that seemed to be about the time the stock market was topping and rolling over. So things definitely turned a little sour in the final 2 to 3 hours on Wednesday. So we'll see how we open up tomorrow. Before we get into all the action, let me just go over the agenda quickly. We're going to take a look at the daily market recap. I'll point you to what happened throughout Wednesday. Then we're going to get into talking technically. I actually think there are a few warning signs, potentially topping signs in the near term that I want to talk about. So I'll get into that. Relative strength. Normally I like to take a look at the sectors, take a look at the industry groups. And I thought when I look at the industry groups, we'll take a look at the summary for the last 3 months, because it's been about 3 months now since we hit that bottom on the major indices back in mid-March. Here we are now mid-June. We're not too far from earnings season starting again, if you can believe that, literally about 4 weeks from now. And speaking of earnings, we'll get into earnings spotlight. I'll show you just maybe some of the top scooter ranked stocks that are on my strong earnings chart list. And then we'll wrap up today with the 3 you must see. I've got 3 companies that actually reported earnings and then responded today from those earnings reports. And they weren't particularly strong, but I'll save those 3 for you for the very end. Before I get into all of that, though, I do want to just point you to earningsbeats.com. If you're not a current Earnings Beats Digest subscriber, it is free. You can just simply go to earningsbeats.com, sign in with your name and email address, hit the subscribe button. We'll make sure you start getting that. It does get published and distributed 3 times a week, Mondays, Wednesdays, and Fridays in the morning, typically before the market opens, sometime maybe just after the market opens. But we'll feature a stock or an industry group, something that'll have some sort of an educational slant. Normally we're talking earnings, we're talking relative strength, those types of things. So generally, I think it's a really good newsletter, and I think you'll enjoy it if you're not currently getting it. So go to earningsbeats.com, type in your name, email address, hit the subscribe button. You can unsubscribe at any time. I think you'll enjoy the newsletter. All right, so what happened on Wednesday? Well, we were up earlier. It wasn't really a wildly volatile day. So at least from that standpoint, the trading range was not that wide. And that was probably a good thing. It was nice to settle down a little bit. But the Dow Jones did finish down near its low of the day, down 170 points, finishing just above the 26,000 level. The S&P 500 was down 11 points, a little more than 1/3 of 1%. NASDAQ did hang on to gains, but that was much less than the earlier gains that we saw. We were well above the 10,000 level, came back down to close at 99.10, only up 15 points for the day. So that was a pretty disappointing finish to the day. Mid caps down 1.4%, small caps down more than 2%. So this theme that we saw throughout the pandemic really is what we saw again on Wednesday, with the NASDAQ leading on a relative basis. When we look at the individual sectors, the only group that was up was the communication services group. Here were the 3 sectors that led us to the downside. And these were also 3 groups that did not do well during the pandemic. Energy stocks down 3.4%, financials down 1.5%, and we had real estate down 1.18%. Among the winners, as I mentioned, communication services, the only sector to finish in positive territory, still holding on above the 20, and really, except for the financials and energy, which both closed back down below their 20-day moving averages, not really good. It's more of an indication, maybe sideways consolidation as opposed to an uptrend. So we'll need to watch that and monitor that further as the week goes on. But those finished back below the 20. You can see communication services still above it. Technology also held up pretty well today. Finished almost flat, almost even on the day, which was better than most of the major indices. So we did see some relative strength there in the technology group. Looking at the 10-year Treasury yield, we finished weak. You can see we're down near the low of the day, almost right on that 20-day moving average. 20-day moving average is 0.731%. We finished today 0.733. And after moving above it and then moving back below it for a few days and then moving up above it, now we're back on it. This seems to be more sideways consolidation as well to me at this point. We do have the PPO in positive territory. We do have the yield currently above the 20, which is above the 50. So I'm not ready to give up just yet on the possibility that this is a trend that has started to the upside, but we certainly are struggling to follow through. I mean, I would have expected the yield on this breakout up to 0.95 to maybe come back, test this breakout area at the 20-day, and then turn back to the upside. We have not seen that. So it is starting to look more like sideways consolidation. And while that's not horrible, it probably will put a lid on equity prices, or at least make it more difficult for equity prices to rise as a result. Now, I talked earlier that last couple of hours of the day, this is a 5-day chart. You can see right here, we had gone positive on the yield, broken back up above the close where we had closed on Tuesday, but that was very brief. We came right back down with a little bit of gusto, and you can see for the most part, the yield was dropping throughout the last couple of hours. That was from 1 o'clock Eastern until 3 o'clock Eastern. And when I pull up the S&P 500, you'll see that 1 o'clock, we were getting close to a top. We actually topped about 130. But the last 2.5 hours look very similar to what happened in the yield, where we really had problems keeping our strength to the upside, ended up turning back to the downside. The S&P 500 printed its low of the day right before the close. That normally is not a great sign. I don't like to finish toward the bottom of a candlestick. I'd rather finish closer to the top. So this might be indicative of a top. I would be careful, especially if we get a gap down tomorrow. That would suggest maybe that we're rolling over and beginning a little bit of a downtrend here. Something to keep an eye on. All right, let's move over to talking technically. And what I wanted to do in talking technically is first talk about the topping signs. Now, I mentioned negative divergences. Negative divergences is one thing that I'm beginning to see on a number of different charts. And I was pointing this out to our Earnings Beats members today. But if you look, take a look at toys. Now, this has been one of the best areas of the market off of that March low. And you could see it even better if I pull it up versus the S&P 500. There was that big rise back February into March, and now we've just been simply sideways consolidating, actually showing strength again here over the past couple of weeks. But when you look at the absolute chart here on toys, look at how we keep going higher and higher, and look at the PPO continuing to drop. So I'm a little concerned. You know, volume, we did break out again today, but if volume had been strong, I'd be more bullish, but volume was actually pretty light on this additional move to the upside. I think you got to be careful with this group. And it's not just the toys, but there are a lot of different areas in the market that you've got to be careful. This is the internet index. And you can see when we topped here in early part of May, we looked pretty good. PPO was still rising. We pulled back, we went to another high. Looked like maybe a slight negative divergence there. Can't quite tell. But we tried one more time to get up and move through that prior high, and we did so. But I think clearly at this point, the PPO has rolled over. So there's definitely negative divergences that I think we have to pay really close attention to here. And it could lead, and what I look for when I see a negative divergence is the potential for a 50-period test and also a PPO centerline test. So you can see we got a little ways to go here on the PPO to get down to the 0 line. Got a long ways to go to get down to the 50-day, although the 50 keeps rising. So maybe what we will see, if I annotate this, maybe what we could see, you got, you know, gap support right here. You can see this gap up from back in mid-May. Maybe we go back and we fill this gap. And about that same time, you also see the 50 coming up from underneath. So it could just be a little sideways consolidation, but still from 2,200, if we were to go back to 2,050, we're talking about 150 points or roughly 7% off of the internet group. And if internet's dropped 7%, I'm not saying they're going to, I'm just saying that there's reason to be a little bit more cautious right now when you start seeing negative divergences, failure to break out. volume declining, options expiring here in just a couple of days, and we're moving into the most historically bearish period of the month. So as far as options go, the third Friday of every month is option expiration Friday. And I just had a Max Payne session or webinar with our members at Earnings Beats last night. And based on what I'm looking at, the S&P 500, you've got more in-the-money calls than you do in-the-money puts. And when you've got that kind of net in-the-money call premium out there, I never put it past market makers to maybe see a little bit of a pullback. So I'm, being a little bit cautious right now. And I think that it would, be smart to be just maybe a little bit more cautious. I'm very bullish the market. I think we're going to go higher in time. I think we're in a secular bull market. But I think we also have to recognize short-term warning signs when we get them. And when we start seeing more and more negative divergences, you see, the fact that options, we're a little bit above Max Payne levels where we could start to see some stocks pulling back. Apple has tremendous number of calls, and we saw that stock actually reverse late in the day, second half of the day in the afternoon. So that could be starting a little bit of a push to the downside. But anytime we approach options, and we've been doing pretty well heading into options, I start looking at the second half of option expiration week and maybe the following week as well as a time when, not just I believe prices could come back, but historically it's been proven that this is the time of the calendar month when we tend to see weakness. Let me give you the June numbers first, and then I'll give you all months. But June 18th through June 26th, and Thursday is June 18th. So when we open up for trading on Thursday, this is starting this period. Those 9 trading days, the 18th to the 26th of June, have produced annualized returns of minus 26.31% since 1950 on the S&P 500. So that's going back 70 years. So it's not just 9 days, it's 9 days every year for the last 70 years. So that's one thing I think we need to keep in mind, is that this time of June historically is not very good. But it's not just June. Let me get these numbers for you. I want to read these numbers. Now, June was 18th to the 26th. Throughout the balance of the year, all months, really it's the 19th to the 25th. And from the 19th to the 25th, I'm going to read you the annualized performance for each day of the month, calendar month. Now, this is all calendar months. So when I give you the 19th, that is also meaning that, and I'll pull up the S&P 500 for you on this while I'm going through these numbers. At least take a look at the S&P. And you can see, by the way, we're not too far from this recent high. So it wouldn't surprise me to see us pull back here a little bit. Also, when you get an uptrend, sometimes you have ABC. I can see the A. This could be the B. We could be starting a C. But anyway, when I give you these percentages, this is for the 19th of every calendar month, the 20th for every calendar month, dating back to 1950. So the 19th of all calendar months, the annualized return, and by the way, this is the worst day of the calendar month, the 19th, which is Friday coming up. Annualized return is minus 33.46%. The 20th, minus 7.57%. The 21st, it's the only positive day, up 6.07%. The 22nd, minus 13.08%. The 23rd, minus 3.08%. The 24th, minus 3.74%. The 25th, minus 6.17%. Now, you might say, well, it's not really that big a number. These numbers for the most part aren't that big, but it's 7 days in a row. And if you look at any other period during the month, there is not one other period at any point during the month where you have consecutive days. There is no other 2-day period in the calendar month back to back that has negative annualized returns since 1950. The 19th to the 25th, every single one of them are negative except the 21st. There's definitely a tendency for the market to move lower from the 19th to the 25th. The other thing is, even on the 21st, even though we have a positive 6.07%, Since 1950, the S&P 500 has an average annualized return, or an average annual return since 1950 of 9%. So every one of these days from the 19th to the 25th are below that 9% level. Definitely, there's a tendency for the market to weaken as we approach options expiration Friday and the week following. And my belief is it has a lot to do with options expiration. When you rise into option expiration, you have a lot of in-the-money calls. And when you have a net in-the-money call premium, it actually behooves market makers. They can make more money if prices fall. That doesn't mean that they lose money if the prices don't fall. But if prices fall, they can make more money. So they have incentive to bring prices down. Very, very important for a short-term trader. Now, if you're long-term, you're buy and hold, you're in following positions for, many, many weeks or months or years, this is nothing to be worried about. I'm talking about short-term trading. There are inefficiencies in the market, and we can take advantage of it. And that's what I'm talking about here. So those are three reasons. I think you've got negative divergences across some of the areas of the market. You've got options expiring. And then historically, the 19th to the 25th, here in June, the 18th to the 26th, historically is a rough period. So those three things combined tells me that at a minimum, doesn't mean we can't go higher. I don't want emails saying, hey, Tom, you said that market was absolutely going to go lower. That's not the case. The market's gone up during this period plenty of times. It's a tendency. So we've had a good run. Like I said, negative divergences. It would behoove market makers with all the in-the-money call premium out there to bring prices down. It's just being smart. All right, let's take a look at some relative strength. I'm going to start with sectors. And so I want to just show you, I look at this at least once a week. Just to keep track, make sure that everything is still, kind of what I'm expecting. But look at technology on a relative basis. It just broke out again, broke out to another high. And you might say, well, is that a relative negative divergence? Well, it is. But when we broke out here back in April, there was a negative divergence. When we first broke out in early March, there was a slight negative divergence. You got to see how far this goes to the upside. And even when we had a real negative divergence, I think it was pretty clear back in here in the middle of 2019, that didn't seem to last, and we continued to move up, and we eventually eliminated that negative divergence. And maybe a fourth factor I could have said for the market potentially topping here. I think if we look at seasonality, I'm going to come back to this chart, but if we look at seasonality and you look at the XLK and we go back the last 20 years, you'll see that June has been the worst month over the last 20 years. And if we compare it to the S&P 500, if we compare technology to the S&P 500, technology has outperformed the S&P 500 only 30% of the time, 30% of Junes over the last 20 years. And you can see there's a net underperformance there. And we don't show net underperformance, but maybe 4 months. And February and December are the only 2 months that show worse relative performance than June. So technology's been leading, but we are still in the middle of June. I don't know. Maybe we see a little bit of weakness coming in. We'll see. All right. So that was the relative strength of technology. Let's keep moving. Consumer discretionary looks great. This is a relative chart. Down here is the absolute chart. So consumer discretionary hasn't yet broken out. We got a double top there, but on a relative basis, very strong. And that's what I'm interested in. I want to know what's leading the market. I would say communication services, even though the second half of May was rough, we're still in a nice uptrend. The relative lines above the 20, above the 50, the PPO, relative PPO is positive. I like that. Now, industrials, on the other hand, rolling back over again. I don't like that. Financials, rolling over. Don't like that. Healthcare. Now, healthcare has been very weak for the last 2 months, but on an absolute basis, it's simply consolidating. This was a group that performed exceptionally well from February through April, or at least the first half of April. So when you have that much relative strength, it's okay to consolidate for a period of time and then pull back. So I'm looking for healthcare to turn back to the upside here. Relative PPO still positive. This is still above the 50, although it is below the 20. I want to see it get back up above that relative 20-week moving average. Consumer staples, very weak. Not liking that. I don't like this 20 going below the 50. Real estate rolling over below the 20 and below the 50. Utilities, same thing, setting a new low actually. Energy, rolling over on a relative basis. Materials, stronger than many of the others I just looked at, actually went through the 50. PPO hasn't quite turned positive yet, and this one rolling back over. Let's see if it holds the 20, but if it doesn't, I'd be careful. So what I'm seeing is the strength that we saw back in March and April, it seems to me like it's returning again. And that makes sense because earnings season is just a month away. And I believe that when we get past this next week to 10 days, if we don't pull back here, I think we're going to continue to run higher into earnings. And I think it's going to be those groups that are going to be expected to produce great results. Many of those pandemic stocks is what I'd be looking for. All right, as far as industry groups, the one thing I like to do with the industry groups on a relative strength basis is I like to view all and put it in summary form. I've got all 104 charts right here, 104 industry groups on a relative basis to the S&P. Now, this is showing intraday, the best performers today, which was toys, insurance brokers, truckers, specialty retail, and home improvements. But what about if we went back over the last 3 months? What's been leading this market off of that bottom back in March? Because I think a lot of these groups are going to be the same groups that will lead us on a relative basis into earnings. And maybe we should even go back. I got 3 months here, but maybe we should even go back 6 months. I don't know. For basically the entire first half of the year. This might be a little bit more representative because it's looking at not only strength during the pandemic, but also before the pandemic. Maybe that's a better way to look at it. We're kind of averaging everything together. But when you look at this list, you can see autos, broadline retail. There's your gold mining, software, computer hardware, recreational products, toys. There's your internet down here, specialty retail, home improvements, specialty finance, trucking, semiconductors, biotechs, financial administration. These are all areas that I would continue to favor. I think they've been leading. Maybe the one exception, because I think the market's going to strengthen, and I think fear will eventually come out of this market. I'd be careful with the mining and gold mining stocks. I just think on a relative basis, they may continue to do okay on an absolute basis. I'm not saying they're going to go cratering to the downside. I just think the market goes higher, and I don't know that these two are going to continue to lead. I think most of their strength came during the pandemic when the market was so fearful. A lot of money rotating over into these two areas. All right, let's keep moving on. I want to go into the earnings spotlight. Really, the only thing I want to point out here is my strong earnings chart list. This is my staple. This is my go-to. This is a ton of homework that I do. I actually just updated this today, and that's going to be available to all of our members. If it's not already available, it should be available later today, where you can go in and download the latest list. But what I like to do, again, go to the view all, pull it up summary form, and here's what happened today. So you can see quickly which stocks did well. Cloudflare, which is net. This has been a great performer. Look at this stock breaking out a couple of days ago, continuing to push higher. They're going to have a huge earnings report based on the way the stock is trading. Look at that volume coming in. Over 16 million shares today, going up 13%. That's a leader. Let's see. Next up, FSLY. This is Fastly. Look at another one. Great move up. Now, this one's moving up with a negative divergence, but look at the volume coming in. It's hard to argue slowing momentum when you're breaking to new highs on heavy volume. That is not a sign of slowing momentum. So don't just look at the PPO, look at volume as well. I mean, if you're truly going to be looking at slowing momentum, as you're setting a new high, we should be seeing light volume. That would confirm what you're seeing on the PPO. This, I would say, refutes it. And I do not, if I have to look at one or the other, if I have to make a decision, I'm going to go with the price breakout along with the heavy volume. To me, that's bullish. I don't care what the PPO is doing. PPO, to me, is secondary to price and volume. All right, let's keep moving. What else we have here? Spotify, internet stock up 7% today. Look at that breakout. Look at the double top. Been sideways consolidating. This looks to me like a nice flag. Nice move up on the flagpole. Flag, sideways consolidation. Volume picks up. We get a breakout. That's a very, very bullish development on Spotify. Now, got to balance that with options expiring. I'd have to go and take a look at the options. I'm sure with it closing at a high, though, there are not going to be very many in-the-money puts. Going to be a lot of in-the-money calls. So what this tells me, though, is if a stock like this were to pull back over the next few days to a week, maybe come back all the way down to that 20-day, I personally would be all over it on the long side. I think this is a stock that's probably going to go a lot higher heading into earnings. All right, maybe take a look at one more. How about one that's not doing so well? Let's switch this around. What didn't do well today? All right, here's a healthcare provider. Stock was down 7%. Yeah, I mean, it tried to make this breakout right here, negative divergence. I think it's coming down probably for a 50-day test. You got some gap support there. I actually would be interested if this stock were to reverse somewhere around that 50-day moving average. I would be okay with RadNet. And again, I said earlier, I think healthcare could turn back to the upside and become a leader again. So RDNT is something I would be watching. So sometimes even the ones that are pulling back can present opportunities. And this is one that I would be paying particular attention to, maybe keeping a close eye on it. All right, let's move into the final segment here. 3 you must see. These were all companies that reported on Tuesday after the bell. And so they were trading Wednesday for the first time with new information. Look at H&R Block, HRB. I see a breakdown of a head and shoulder top. So we were rallying off of this. I see a left shoulder, neckline, head, neckline, right shoulder, and the breakdown with heavy volume. This to me measures probably another 10 to 15% lower from the breakdown level. So I'm going to say maybe back down. I'm going to say it could go as low as this low over here back in mid-May. I'd be looking for maybe 14.5 on H&R Block. Oracle. I was hoping we'd get a breakout here on Oracle. Big move up, sideways consolidation, earnings were coming up. Thought maybe we'd get a good report and a breakout. Problem was they missed on their revenues. So we failed to get the breakout. We gapped down, traded off to the downside most of the day. Really needs to hold this area around 50.75 to about 51 bucks. We're still holding it at this point. Volume was heavy on Wednesday, but we didn't break down. So far, still holding in there, but I would be careful. And then the last one is Groupon. Groupon had moved up. Look at the big gap down. And I remember on the show this morning over at Earnings Beats, I talked about this gap resistance area. We were going to gap up. We wanted to see what would happen after that. Well, we found out. Huge, huge selling all day long. If you look at the 5-day, 10-minute chart, look at this. This stock had almost no buyers. Heavy volume selling all day long. Not a good look to it. So far, so good as far as holding on to 20 support. But with that kind of volume, I'd be careful. That's it for today. Everybody have a great day on Thursday. Happy trading all.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.